In this week's market update, a bad few days for shares as trade war fears are rekindled. Italy reminds investors that political risk has not gone away, and central banks are in focus after Jerome Powell's first congressional testimony. Donald Trump reminded us this week that his presidency is a two-edged sword as far as the markets are concerned. His election just over a year ago was greeted by optimism about the potential for tax reforms, deregulation and infrastructure spending. But it was also met with pessimism about his protectionist America First instincts and the potential that this might spill over into a damaging trade war. Well, for much of the past year, the Trump bark has seemed to be worse than his bite, and investors have therefore focused on the positives. The announcement of tax reforms before Christmas seemed to justify the market's strong showing last year. So, last week's unexpected announcement of steel and aluminium tariffs came as a big shock to investors. Maybe they'd been right all along to worry about the president's nationalism. The immediate response to his calls for a 25% tariff on steel imports and a 10% tax on aluminium was dismay, from America's trading partners, but also from plenty of free trade Republicans as well. Few people other than the president himself and perhaps the chief executives of US steel producers, whose shares rose strongly on the news, can see any long-term benefit in this kind of protectionism. For one thing, the companies that will be hit by rising steel and aluminium prices, notably car makers, employ many more people than the steel mills themselves. Rising import costs are likely to stoke inflation, building on the market's recent fears that rising prices will force interest rates and bond yields higher. General Motors shares were clobbered by the news with a fall of nearly 10%. Ford was 5% lower, and Fiat Chrysler, Daimler and Toyota shares also fell sharply. The immediate impact of the tariffs may not be such a worry. Steel and aluminium imports represent only about 2% of the total in America. The bigger risk is that other countries could retaliate with their own tariffs. China, in particular, may consider tit-for-tat measures to restrict US agricultural exports. History does not look kindly on the imposition of tariffs. Protectionism was a key contributor to the Great Depression in the 1930s, and more recently, George Bush was forced to reverse a similar steel tax when he introduced it in 2002. The World Trade Organization ruled it illegal, and the EU threatened to retaliate against US car and fruit exports. The market reaction was also negative. The S&P 500 suffered 3 consecutive falls of more than 1% for the first time in 2 years last week. The VIX Volatility Index rose again to 26, that's higher than the long-term average of 20, as the calm that had reigned since the early February market wobble evaporated. The dollar weakened and Treasury yields rose. Overall, the FTSE All-World Index fell by 2.7% on the week, the S&P 500 was 3% lower, and the Euro Stoxx 600 was down 3.6%. The FTSE 100 is holding above 7,000, but it's still about 10% below its recent peak. Markets had already been under pressure before the tariff bombshell as investors focused on the first outing by Fed Chairman Jerome Powell in front of 2 congressional committees. In the first of these, Mr. Powell spooked markets by focusing on the US economy's economic growth and hinting at a slightly faster than expected rate of monetary tightening. Investors have started to price in 4 interest rate hikes this year rather than 3, and a slightly higher endpoint for rates at the end of the current tightening cycle. This week, the central banks in Europe and Japan will be the focus. In both cases, the mounting fear among investors is that improving economic situations will lead to faster and more aggressive unwinds of recent monetary accommodation. In Europe, the ECB has promised to continue quantitative easing until the end of the year, but more hawkish policymakers are calling for the tapering of this process to be brought forward. In Japan, a second term for Bank Governor Haruhiko Kuroda should mean more stimulus, but Japan too is enjoying its longest run of economic growth since the 1980s, so the end is in sight for Japan's super easy policy too. As well as worrying about Trump's trade policies a year ago, investors were also concerned about political risk, as a string of European elections threatened victories for anti-establishment and particularly anti-EU parties. In practice, the mainstream parties prevailed in Holland, France and Germany in the 2017 elections. But this weekend, the last of the series in Italy did live up to investors' worst expectations. Voters sent a strong message both to the Italian political establishment but also to the EU as the populist Five Star movement made sweeping gains in Sunday's general election. A hung parliament now looks certain, leading to a prolonged period of negotiations to form a viable government. The Five Star movement was not the biggest party, but its 32% was a bruising rebuke for the centrist parties which have presided over a flagging economy and failed to deal effectively with a growing migrant crisis. The most votes were captured by the centre-right coalition fronted by former Prime Minister Silvio Berlusconi, but it too failed to capture an absolute majority. Another right-wing populist party, the Northern League, also surprised observers with a better than expected 18% of the vote. Italian government bonds bore the brunt of investor nervousness, with the 10-year benchmark bond yield rising more than 7 basis points to just over 2.1%. That's its highest in 5 sessions. Meanwhile, in the equity market, the FTSE MIB index was down 0.6%, bouncing off a 1% fall at the start of trading on Monday morning. The euro was actually largely unchanged at $1.23, and it remains 2.5% higher year to date against the US currency. Now, the Italian election comes at a bad time for the EU, which is in the thick of negotiations with Britain over a proposed transition period from March 2019, which is when the UK is scheduled to officially leave the single trading bloc. Last week, Theresa May made a widely watched speech in which she laid out the most detailed position yet for the UK government. Her well-trailed position is designed to please the warring constituencies within her cabinet. Unsurprisingly, her cherry-picking approach to regulatory alignment, which will be close for sectors with complex pan-European supply lines, looser elsewhere, is of no interest to the EU side. It has always seen things through a more legalistic and rule-based prism. Investors in Asia are also getting to grips with a political bombshell after the National People's Congress rubber-stamped the decision announced last week to scrap the 10-year presidential term limit. The plan to allow presidents to remain in office indefinitely signalled an unparalleled concentration of power in the hands of Xi Jinping, who has become the most significant Chinese leader since Mao Zedong died in 1976. Indeed, it was in response to the unbridled power of Mao during the disastrous Cultural Revolution in the 60s and 70s that the 10-year limit was introduced by Deng Xiaoping in the early 1980s. Now, it's far from clear whether the consolidation of power in Beijing is a good or a bad thing from a market perspective. Although widely criticised, some investors believe that Xi Jinping is a genuine economic reformer, and a period of stability will usher in a continuation of the opening up of China's equity, currency and bond markets. In particular, they believe that political stability will make it more likely that high levels of corporate debts, mainly in state-owned enterprises, can be gradually managed down over a period of several years. Now, back on the economic front, the main focus of attention this week will be Friday's non-farm payroll employment numbers. These are expected to continue the recent upbeat run of job creation, with 200,000 jobs expected to have been created for the second month running. The unemployment rate is forecast to have fallen by 0.1% to 4%, and that would be the lowest since December 2000, when it fell to 3.9%.